Good morning, my dear students. Welcome to today's class. So please remember what I taught yesterday. Yesterday I taught what is a capital, what is the liabilities, assets. There are two types of asset: fixed asset and current asset. Fixed asset again divided into tangible and intangible assets. Then we studied a trade receivable. In the trade receivable, two items are there. One is a bills receivable and the second one is a debtors. Then trade payables. In the trade payables, two items are there. One is a bills payable and creditors. Debtor means when a business sells its goods, sell his goods to his customers without receiving the money, then those customers are known as debtors. Okay, business is selling its goods without receiving the money. Money he will receive in future. So to whom he sold goods to someone, that person is known as debtors. From the debtor we will receive the money in future. Then I explained what is creditors. Creditor means a business purchases without giving money. Then in the future we have to give the money. So from whom the business purchased the goods without giving the money, that person is known as creditors. Okay, this much I taught last day. Then today we can see page number 1.7. Page number 1.7. Goods, number 11. Okay, here goods means goods includes all those things which are purchased for resale or which are used for producing the finished products and which are also meant to be sold. Once again I will tell, goods means all the things which are purchased for resale purpose. Otherwise, all the things which are purchased to make a new product and that new product which is meant for sale. So those items are known as goods. Okay, if we are coming to an example, when a furniture businessman, he purchases different kind of furniture items like a chair, table, almara, those things he is purchasing, this will be goods for him. And his intention also important. When he is purchasing these things, that should be for resale purpose. Then only it is becoming goods. And a furniture merchant, he is purchasing some chair. It is not for resale purpose. That chair he want to keep in the office when the customers are coming. He want to give that chair for sitting purpose, for the seating arrangement. He is purchased that chairs. Then these chairs will not be goods for him. Understood? It is very important. So when something is purchasing for resale purpose, then only it is becoming goods for him. Example, that is very clear. A furniture merchant, when he is purchasing some furnitures and furniture merchant purchases a furniture that is for resale purpose, then only it is a goods. So and he is purchasing that is for the business use. In the business he want to use that, then it will be not goods. Okay, then it will be termed as asset. Then see the textbook, there it is mentioned. Thus one example is given there. Thus for a furniture dealer, purchases of chair and table is termed as goods, while for others it is furniture and is termed as asset. It means when a cloth merchant is purchasing some furniture, tables he is purchasing, then it is not a goods for him, because cloth merchant he is selling not furniture, he is selling the cloth materials. That is why for a cloth merchant, furniture is not an goods. It is not a goods, but it is an asset. And for a furniture businessman, when he is purchasing different kind of furnitures like a chair, table, almara, these things he is purchasing, it will be goods for him. And one more thing, and he is purchasing these things if he want to use in the business, then it will not be goods. So those items which is purchasing for resale purpose, that is known as goods. And one more thing is there. Some business firms are there. They are purchasing something and they are making a new product. Then they are purchasing raw materials. Okay, they are not purchasing finished product. They are purchasing different type of raw materials. They are purchasing and they are making a new product. They are manufacturing. They are manufacturing and making a new product and they are selling that product. In this case, what are the things he is purchasing for making a product? All those items are known as goods. I think it is very clear. Okay. And in the textbook, once again, you can see that paragraph very clearly. Example is given there. So that is the meaning of goods. Now we can see what is the meaning of purchases. It is the same page number 1.7. It is a 9th item, purchases. When a business tells purchased rupees 1 lakh, its meaning is they purchased goods. Goods will be silent always there. Okay. Simply they are telling that purchases rupees 1 lakh or purchase rupees 5 lakh. It means they purchased some materials for resale purpose. Always goods is silent there. Okay. And if he is purchasing something else, then along with the purchase, its name also will be there. If a name is not given, simply it is telling that purchases, then it will be always goods. So see the textbook, the term purchases is used only for the purchase of goods in which the business deals. Okay. And there it is saying that for a manufacturer businessman, he is purchasing different type of raw materials, then it will be purchases. And for a trading concern, when the different items he is purchasing and immediately he want to resell it, then it is, and that is will be goods. He is purchasing goods, then only it is known as purchases. Okay. And when a cloth businessman is purchasing some cloth materials, it will be purchases. Simply we will say purchases. It will not say that he purchased some clothes or he purchased a shirt, purchased some other items. No need of telling. Simply telling that purchase means then we can understand that will be for goods only he purchased. Okay. So this is the meaning of goods. Then we can see what is the meaning of purchase return. Purchases, purchase return. That is the next number. Okay. After 9, it is given as a next paragraph. It is given purchase return. Purchase return means when we after purchasing the goods, if we are not satisfied with that goods, then we are rejecting that goods. We are sending back that goods to the supplier. We are purchasing goods from the supplier. Okay. Then we are not satisfied. Otherwise, when we purchased, the quantities became more. We don't want that much quantities. Then we can return back those goods to that person. Then it is known as a purchase return. Goods only we are returning. Okay. And purchase return is also known as return outwards because it is going outside. Okay. It is opposite of purchases. Purchase return means opposite of purchases. We purchased some goods, and due to some reasons we do not want some goods, so that goods we are returning to the supplier. That is known as purchase return. Then we can see what is sales. Number 10. Sales means transfer of ownership of goods or services to customer for a price. It means we are handing over the ownership of something to someone, or we are selling the goods. Okay, sales means goods we are handing over to some other person and money we will receive. Okay, that ownership of that particular item we given to some other person, money we can receive now or we can receive in future, and that should be goods. Then only we are selling it as a sale. And if a stationary businessman What is this for the stationery businessman? Goods will be all the stationery items like a pen, paper, pencil, scale, then like that many items are there. These all are the goods for him. And a stationery businessman, he is selling one old chair. Okay, that is out of use. He want to purchase a new chair. That is why the old chair he sold and he got some money. This we cannot tell as a sale. Sale means what? Goods should be given. Then only it will become sales. Okay, something is became old, and if you are giving to someone, it is not a sale. Sale should be always the goods. For a stationery businessman, chair is not a stationery item. Okay, for a stationery businessman, when he is selling stationery items, this is known as simply sales. Clear? And a cloth businessman, cloth merchant, he is selling different cloth materials or different dress items. He is selling outside, it will be sales. But if he is selling one old AC was there, it is not working, so he want to purchase a new one, and that AC is giving to someone else. Its ownership he is handing over to another one. Then this we will not call as a sale. Sale means there one thing is silent, one thing is hidden. That is goods. Okay, goods if he is giving to someone else, then only it is becoming sales. Clear? Then purchase return, like that sales return is there. Sales return means once we sold some goods and we are selling goods to our customers. Okay, and that customer, if they are returning some of the goods to us, it is known as a sales return. Clear? We sold some goods due to some reasons. That reason may be that the goods is not according to their expectations. Otherwise, some defective goods is there, or the number of goods became more. They do not want that much goods. So some of the goods they purchased from us, we sold it to them. Okay, and that goods they are returning to us. That is known as a sales return. Clear? And one more thing, there are two type of purchases there: cash purchase and cash purchase and credit purchases. Cash purchase means we purchased on the same time we given the money. That is known as cash purchases. Credit purchases means we purchased the goods but money is not given. Money we will give in the future. We agreed that some after 1 month or after 3 months we will give you the money. Then it is credit purchases. At the time of credit purchases, creditors are coming. Okay. Then sales are two type. One is a cash sales and other one is a credit sales. Cash sales means when we sold the goods, the same time we received the money. That is known as a cash sales. And the other sale is credit sales. Credit sales means we sold the goods, but the money we are receiving, money we will receive in the future. Okay, that person is agreed that after 1 or 2 months he will give the money to us. At the time of sales he agreed, he promised. Then this sale is known as a credit sales. Okay, so credit sale is there, cash sale is there. Credit purchase is there, cash purchase is there. Did you understand its difference? At the time of credit sales, debtors are coming. Okay, at the time of credit purchases, creditors are coming. And I taught you liability and assets. Creditors are example of liability. Okay, creditors are example of liability, because I explained the liabilities like that. The money payable to someone, that is known as liabilities. What is the meaning of creditors? We purchased the goods but the money is not given. So money we have to give in the coming days. That is why creditors are the example of liabilities. Okay, and debtors, this is an example of asset, because in the asset many meaning is there for the asset. One of the meaning is money receivable will be asset. Okay, in the future we will receive some money, then it will be an asset. And the debtor is an example of, there are two type of asset is there: fixed asset and current asset, or non-current asset and current asset. Debtors are example of current assets. Do you remember what is the meaning of current asset? Current asset means those assets which we can convert into cash within 1 year. That asset is known as the current asset. Normally when we are selling the goods to someone else, we will not give more than 1 year time. Okay, within 1 year we will that will be our agreement for the sales. Okay, within 1 year we have to get the money. Then debtor will be a current asset. It is an example of a current asset. Okay, so debtor is an example of current asset and creditor is an example of liabilities. Liabilities also there are two types that I did not tell yesterday. Liabilities also there are two types. One is non-current liabilities and other one is current liabilities. Non-current liabilities means all the liabilities which is payable after 1 year. Okay, all the liabilities which are payable after 1 year, that is known as non-current liabilities or fixed liabilities. Like a fixed asset is also known as a non-current asset. So liabilities also non-current liabilities or fixed liabilities. This will be those liabilities which are payable after 1 year, that is known as non-current liabilities. Then current liability. Current liabilities means all the liabilities which is payable within 1 year, that is known as current liabilities. Creditors are example of current liabilities. Okay, and the liabilities are another two type of liabilities also there. There are two type of liabilities. One is external liabilities and internal liabilities. Okay, external liabilities and internal liabilities. Internal liabilities means the liability payable to its owner. Okay, liability payable to the businessman, that is known as internal liability. External liabilities means all the money payable to outsiders, that is known as external liabilities. And yesterday I told business and businessman, they are not the same. They are different person. Business is a person created by law. Okay, it is an artificial person and it is created by a law. Okay, created by law. And we will not mix up the businessman's property and business property. We will not mix up that. We will keep separately. Okay, that is why liabilities are two type. One is liability payable to the businessman, that is internal liability, and second one is external liability, all the money payable to outsiders, that is known as external liabilities. Okay, next another term we can see from page number 1.7, that is stock or stock in trade. Okay, its meaning is on a particular day how much goods are lying with us. Okay, how much goods are lying with us, that is known as stock. Normally stock we are telling end of the year. End of the year, how much value stock is with us. How much means many purchases will be there. Okay, many sales will be there. So after this purchase and sales, always its number is increasing and decreasing. Whenever we are purchasing, the number in the business, the goods number is or its quantity is increasing, and when we are selling the goods, its quantity is decreasing. So always there is a fluctuation of goods in the business. Okay, when we are purchasing, it is increasing, and when the sale is there, it will decrease. So on a particular day, how much value of goods is there in the business, that is known as stock. Is it clear? Okay, so the value of stock, that will be depend upon the purchase and sales. Suppose 1 year we purchased and there was no sale, then the full purchases amount is will be the stock value. Okay, and when the sale is there, stock will decrease. When the purchase is there, stock will increase. So the stock means the goods which are kept in the business for sale, that is not at sale, that we are going to sell. Okay, we are going to sell, that is known as stock. And stock is there are two type of stock is there normally when we are telling according to the date wise. One is closing stock and the second one is opening stock. Okay, closing stock and opening stock. Normally, suppose we are doing a business for a long period, we are doing the business, and that business we are dividing into different period. Okay, normally 1 year we are taking as a one period, 1 year. That may be for a business firms, their starting will be month will be normally it is April. April they are starting, and from April we are counting 12 months, it will reach March. Okay, so normally the business they are taking their year like and as a students you are having academic year. Normally academic year is starting on April and it's ends on after 12 months. After next year March it is getting over. That is an academic year. The same way for the business also 1 year is there. Starting time and end time is there. According and 12 months period we are taking as a 1 year for the business, and this is known as accounting year. Okay, here it is not academic, here it is a accounting year, and for a business the accounting year that is starts on 1st April. Usually it is a 1st April, and some business firms they will start their process on 1st January, then they will end on 31st December. But the common means according to government rule and all, according to tax authorities and all, this accepted accounting year will be starting by on 1st April and it will end on 31st March. Okay, okay, that you understood. Accounting year understood. It is starting on 1st April and it is ends on 31st March. Otherwise, it is starting on 1st January and it ends on the same year 31st December. So I am explaining about the meaning of opening stock and closing stock. Now come to the meaning of closing stock. Closing stock means the value of stock at the end of the accounting year. Value of stock at the end of the accounting year, that is known as a closing stock. Then opening stock will be, and when 1 year is over, suppose our year is 2010, April 1, we started 1 year and it is ends on 2011, 31st March. Okay, so 1 year is over. So the value of stock on 31st March 2011, that is known as a closing stock. Then next day is what? 2011 April 1. Next day we are starting the next accounting year. Okay, the business we are continuing for a 20 years, suppose 20 years, then this will divide into 20 years. Okay, 1 year will be first accounting year, next year will be second accounting year, like that. The purpose is after 1 year is completed, we want to know the result of the business. That is why, and if we are evaluating the result after 20 year, then it will not help us to make some changes. Okay, so businessman, he want to know what is the result of the business, and it is knowing only at the end of the business, it will not help him to make the sufficient changes. If he is periodically evaluating, then he can make sufficient changes. He can reduce his expenses and he can find out in which area he need to focus more. So for this, for finding these things, normally he will not wait up to completing the business. Before that, when 1 year is over, he will just evaluate the result. Okay, so that will be normally the business he is taking from April to 31st March. Then what is the value stock on 31st March? That is known as a closing stock. Then next day he is starting the next accounting year. Business he is continuing. Then next day means April 1st. April 1st, what the previous days stock only there in the next day. So opening stock means 1st April 2011. What is the value of stock? That is known as a closing stock. And one more thing, the closing stock of this accounting year will be the opening stock of next accounting year, because only 1 day difference only there. Okay, if we are 1 year is ending on 31st March 2011, next day we are starting the next accounting year. So what is the value of closing stock today? The same will be tomorrow morning the value of stock. That is why I told this statement. The value of closing stock at the end of the accounting year will be same as the value of opening stock in the beginning of the accounting year. Okay, opening stock we are using the beginning of the accounting year, and the closing stock we are using related to the end of the accounting year. Clear? What I told now, it is given in the page number 1.7 and 1.8 regarding the opening stock and closing stock it is given. Then another term it is given, what is the inventory. Okay, what is the inventory? And inventory means it is above the closing stock. Okay, in the inventory closing stock also included. In the inventory stock also included, but inventory means it is a little more broader term. In that, and normally we are telling the stock, this is the goods which are ready for sale. Okay, the goods which are ready for sale, that is known as normally stock. But inventory means not only the finished goods, not only the finished goods. For a manufacturing concerns, when the manufacturing is started, there is a chance some goods are not finished. Okay, some goods are in the process of converting into finished goods. Then there is a raw materials will be there. We purchased and before the accounts year closes, that process is not completed. That is why some raw material is there and some semi-finished goods also there. Semi-finished means half of the work is over. Manufacturing work only half over. Then those goods are known as semi-finished goods. So when we are telling the inventory, in the inventory finished goods is there, raw material is there and semi-finished goods. These three items will be included. Then it is known as inventory. But stock means it includes only finished goods. So this is the difference of inventory and stock. Okay. Now we can see another term. It is given in page number 1.9. That is expenditure. Okay. Number 17. Number 17. Take that page. Page number 1.9. Number 17. Expenditure. And here it is saying that any disbursement of cash or transfer of property or incurring a liability for the purpose of acquiring assets, goods or services is called expenditure. It means that any type of payment for the receipt of a benefit is termed as expenditure. So here the meaning of expenditure is when we are making any type of payment. Okay, any type of payment, that may be we are giving some salary, then we have to give some cash. Okay, and we are purchased some furniture, we purchased, then we paid some money. So any type of payment we are giving for getting something. Okay, sometimes for getting some services we are giving the money. So that payment of money, or we need some asset. Okay, like one furniture we want and one AC we want. So when we are purchasing this, we have to give some money. So any type of payment for getting something, that is known as expenditure. Is it clear? Okay, I am reading from the textbook. Listen. Any disbursement of cash, disbursement means payment of cash, or transfer of property. If you are not giving cash, then we have to give something else. Okay, if a cash we are not giving, then we have to transfer some other property, something, or incurring a liability for the purpose of acquiring asset. So for getting some assets, otherwise here assets, goods or services. So for getting any services or for getting some goods or for getting some assets, we have to give some payment. So that payment is known as capital expenditure. Okay, and there are two type of capital expenditure is there. Two type of capital expenditure is there. One is revenue expenditure, and the second one is capital expenditure. There are two type of expenditures are there. One is revenue expenditure and the second one is capital expenditure. And this capital expenditure means when we are purchasing or when we are making the payments, and it's a benefit if we are getting more than 1 year, that is known as a capital expenditure. Okay, the time we have to consider. We paid some payments and it's a benefit if we are getting more than 1 year, then that payment is known as a capital expenditure. Revenue expenditure means we made some payments, but it's a benefit we are not getting more than 1 year. Within 1 year, it's a benefit will be over. Okay, so those payment is known as a revenue expenditure. And capital expenditure means that is not a repeating nature. Capital expenditure one time if you are giving, that is enough, no need of giving again. But revenue expenditure, this will be in a repeating nature. Once we paid, but again we have to pay. So for example, if you are telling we are purchasing one vehicle, okay, and so we purchased one vehicle, so one time payment is enough. And when the vehicle we are using, we need some fuel, okay, petrol is required, so we are purchasing the petrol, and when we are running the vehicle, petrol will get over, and again we have to purchase the petrol. So here, how much money we spend to purchase that vehicle, it is an example of capital expenditure. And how much money we are spending for the petrol, that is an example of a revenue expenditure. Okay, so when we purchased one vehicle, it's a benefit we are getting more than 1 year. Okay, it's a life is a long life is there, so we can use more than 1 year. After 1 year, this vehicle will not disappear. But when we are purchasing the petrol, so it will get over. Okay, after some, according to the how much kilometer we are traveling, according to that the petrol will get over. Then again we have to purchase it. Okay, that also will get over. So in 1 year, many times we have to purchase the petrol. So the meaning of a revenue expenditure is like a petrol. Petrol we are continuously according to the use of the vehicle, we need to purchase the petrol again and again. Repeating nature. Okay, revenue expenditures are a repeating nature, but a capital expenditure is not a repeating nature. Only one time payment is enough. And capital expenditure means the payment we made and it's a benefit we are getting more than 1 year. And revenue expenditure means it's a benefit we are getting within 1 year only. And again we have to make the payment. That is a revenue expenditure. So I am reading the textbook, just listen that the capital expenditure and revenue expenditure. Firstly, capital expenditure. Any expenditure which is incurred in acquiring or increasing the value of a fixed asset is termed as capital expenditure. We studied what is a fixed asset. Fixed asset is a non-current asset, and when we purchased that, the money invested in particular item, it's a benefit we are getting more than 1 year. That is known as a fixed asset. So the money we spend to purchase any fixed asset, that is an example of capital expenditure. As such, the amount spent on the purchase or erection of building, plant, furniture, etc. is a capital expenditure. Such expenditure yield benefit over a long period. Okay, so it's a benefit we are getting more than 1 year. That is a capital expenditure. Now see the revenue expenditure. Any expenditure, the full benefit of which is received during one accounting period is termed as revenue expenditure. As such, all the revenue expenditure are debited to trading and profit and loss accounts. First time you are hearing that term, trading and profit loss accounts. Okay, that I will explain, just wait. Such expenditure does not result in an increase in the earning capacity of the business, but only helps in maintaining the existing earning capacity. It also does not bring into existence an asset or an enduring nature. So you remember what example I told you. I told the example of a vehicle. Okay, so vehicle when you are purchasing, only one time only we are making the payments. If its cost is 70,000 to purchase the one vehicle and its registration and all, if 70,000 is the money we have to spend, then this 70,000 is an example of a capital expenditure. Okay, but we are for running the vehicle we need some fuel. So for the petrol we are spending near about 1,000 rupees we spend for 1 month. Then this 1,000 is an example of a revenue expenditure. Revenue expenditure is a repeating nature. Capital expenditure is not a repeating nature. One time payment we made, that is enough. Then here it is saying that in the revenue expenditure they used one term. These are debited to trading and profit loss accounts. Okay, the trading and profit loss account, it means at the end of the accounting year, I told the business are ending on 31st March every year. Okay, 31st March every year. Then on that day, we will prepare two things. One is trading and profit loss account, and the second one is balance sheet. Okay, end of the accounting year, every business firm, they need to prepare two things. One is trading and profit and loss accounts, and the second one is a balance sheet. This we will study in the same year. Okay, in our class 11 we will study this one, and I will show you how the trading and profit loss account is looking. Here you can see this one. Okay, so this it is written there, trading and profit loss account, and it is making in a table form. Then after that you can see down it is made there balance sheet. Okay, so actually this trading and profit loss account and this balance sheet, this we are making end of the accounting year. Okay, this year we will study how to make this one. So here the revenue expenditure, this will be coming in the first one. In the firstly I showed you trading and profit loss account. Trading and profit loss account is this much. In that revenue expenditures are coming, and capital expenditures are coming in the down. After the trading and profit loss account, we are making this balance sheet. So in the balance sheet, this capital expenditure we are taking. The purpose of preparing this trading and profit loss account is we want to find out the result. We want to find out the profit of the business. For that purpose, this is trading and profit loss account we are preparing. And the balance sheet we are preparing to find out the value of different assets, liabilities and capital. Balance sheet we are preparing on the basis of, yesterday I given one formula. 3 formulas I given. Accounting equation I given. Accounting equation is asset will be equal to capital plus liabilities. On the basis of that equation, we are making that second thing, that is a balance sheet. Okay, so in the balance sheet we are taking this capital expenditure. Revenue expenditure we are taking in the before balance sheet we are making trading and profit loss account. So in the trading and profit loss account we are taking revenue expenditure, and in the balance sheet we are taking that capital expenditure. This is both trading and profit loss account and balance sheet we are making end of the accounting year. So now I explained this 17th item, that is expenditure. Expenditures are 2, capital expenditure and revenue expenditure. So before 17, then 16th item, it is given expenses. Okay, see what is the meaning of expenses. Expenses is the cost incurred in producing and selling the goods and services. According to Finney and Miller, expense is the cost of use of things or services for the purpose of generating revenue. Following are included in terms of expenses: cost of goods sold, amount paid for rent, commission, salary, advertisement, etc. Decline in the value of an asset caused by the use of such asset for business purpose, or depreciation is also an expense. Depreciation, that is third point, I will explain later. Okay, and here the first one is cost of goods sold. Cost of goods sold means for selling the goods, many expenses we have to meet. They are we have to purchase the raw material, or we have to purchase the some goods we have to purchase. Then after purchasing it, when we are purchasing that goods for transporting that goods from there to our place, we have to spend some money. Okay, so that money also will be included in the cost of goods sold. Then in our for a manufacturing concerns, for converting the goods into that raw material into finished goods, some manufacturing expenses are there. Wages will be there, factory expense will be there, all will be included in the cost of goods sold. Okay, so that is coming. Then amount paid for rent, commission, salary and advertisement means for running a business, lot of expenses are there. That is like rent of the building or rent of the office room. Then advertisement we have to give, salary to employees, and commission we have to give. So all these items together is known as expenses. And in another way, if you are telling the expense means revenue expenditure is known as expenses. Revenue expenditure is expenses. Means expense means it's a benefit we are getting within 1 year. Okay. And this all these expenses we are taking in the trading and profitless accounts. Okay, revenue expenditure and expenses both are having the same meaning. Okay, now one more time, then after that we can wind up for today's class. It is given in page number 1.3. Okay, 1.3. There, third one, voucher. Okay, I am reading. You just listen what is a voucher. Voucher is a document which provides the authorization to pay and on the basis of which the business transactions are first of all recorded in the books of accounts. A separate voucher is prepared for each transaction and it specifies the accounts to be debited or credited. The form of voucher varies from firm to firm since vouchers are printed separately by different firms in their own names. Vouchers are prepared by accountants and each voucher is numbered and countersigned by an authorized person of the firm. Here, the meaning of voucher, they are telling that it is a document, okay, which provides the authorization to pay and on the basis of which the business transactions are first of all recorded in the books of account. It means whenever any payment is made by the firm, then it should be one records should be there. Okay, when we are making any payment, then it should be one document, one written document should be there for making that payment. So that is known as a voucher. Voucher is a document, and when the payment is making, in that voucher it is mentioned to whom that payment is made, why that payment is made. Okay, so it is a printed one. And different firms are using different type of vouchers because every firm is printing the vouchers in their name. That business, what is the name of that institution? In that name, they are printing the voucher. And by seeing the voucher only, they are writing the transactions in the books of accounts. Okay, that is why the transactions are firstly entered here when any payment is made, and it is the proof of making any payment. If any payment is made, then by seeing the voucher we can understand to whom that payment is made and why that payment is made. Its date also will be mentioned. So when that payment is made, this everything, all the information we are getting from the voucher. So on the basis of voucher, actually we are going to record the transactions. Okay, so that is a voucher. And it is saying that vouchers are prepared by accountant because every business firm, accountant, he is having the ability to understand the transactions, and he is only writing the transactions in the books of account. Okay, that person is known as a accountant. One accountant should study this our subject. This accountancy subject he should study. Then only he can record the transactions in a systematic way. So this is a voucher. So by this we are winding up my class. Then revise this much, and if you want you can watch once again this video. Goodbye.